what's the maximum issue age? What's the minimum premium? Which one has a bonus because we got to make up for a surrender charge? Again, every bit of information is right there at your fingertips on Annuity Rate Watch. And that can be found at the wfg.amsfsg.com. Okay? We talked about the sales. Now, let's talk about annuities. Annuities have been around for hundreds of years. They first started as a pension. A pension is a single premium immediate annuity. It's where a corporation goes ahead and puts money away for an employee, and when the employee decides to retire, the corporation goes to an insurance carrier and says, hey, we've got this person, they're this age, they've got this amount of money, please send us over the income payment sheet. The income payment sheet will give you a life-only payout factor. Could be a joint life, could be a period certain, it could be a life with a period certain, it could be a life with a cash refund, but it is a payment of income on a monthly basis to the retired employee, otherwise known as a pension. Now, those have gone away considerably. Why? Well, over the last 15 years, we've had extremely low interest rates. Very, very difficult to price. Number two, we've got people that are living a lot longer. Back in about 20, 25 years, 30 years ago, the average individual that retired at 65 had the life expectancy to 72. Now we have people that retire at 65. Their life expectancy for a male is about 82 and a female about 86. So people are living a lot longer, which is causing pensions to be much more expensive and not as valuable. Now there is what also is called a single premium deferred immediate. That's like a jumbo shrimp, right? Deferred immediate. It's really geared towards those professional athletes or entertainers that get big lump sums of money. They want to protect it against lawsuits or anything of that nature, as well as provide an income stream in the future. Again, they'll lose control of the principal by doing this, but again, at that point, it's not going to be subjected to any type of lawsuits that could potentially arise, okay? Because it's no longer their asset. The income is their asset, okay? Then was created the fixed deferred annuity. It's based on current interest rates. The fixed interest rates are guaranteed for either 1 year or over a multi-year period of time. The fixed interest rate, again, is guaranteed for 1 year. It can readjust in years 2 and beyond. You've got 3-year, 5-year, 7-year, 9-year, 10-year fixed annuities. Most of the individuals buying fixed annuities are not going to go out further than 5 to 7 years. Same thing with the multi-year guaranteed annuity, otherwise known as a MIGA. The multi-year right now has become more and more popular. Why? Because interest rates have come up much higher. On a 5-year and a 7-year multi-year guaranteed annuity rate, our rates are over 5%. So we can lock in 5% for 5 to 7 years. It's not a bad rate. Okay, nobody knows where rates are going to go. They were supposed to go down this year. We haven't seen them move. We've heard the Fed is not going to move interest rates this year. But because interest rates were so low and the returns were so low on the fixed deferred annuities, fixed index annuities became extremely popular over the last 15 to 20 years. In actuality, the fixed index annuity has been around over 30 years. I utilized my first index annuity back in 1992 when it was called an equity index annuity. When it was an equity index annuity, we were seeing returns that were very consistent with the equities market. Back then, we were taking a look at the equity market like the S&P 500, and we're seeing average annual returns of somewhere between 7 and 8%. Well, with the fixed index annuities, when we don't ever have to make up losses, because returns have a floor of 0. We were seeing returns in the 8, 9, 10% range. And so therefore, again, equity index annuities is what they were originally called. It wasn't until interest rates came way down is when they started calling them fixed index annuities. Remember, the interest rate returns are all tied to an index like the S&P 500 or the NASDAQ or the Russell or any of our volatile control strategies that we're seeing today, okay? When we take a look at index annuities, the lower the current interest rate market is, and we use the 10-year Treasury as a benchmark, the lower the interest rates are, the lower the potential returns are on fixed index annuities. The higher the interest rates are on the 10-year Treasury, the higher the opportunity for returns. So up until probably mid-2021, beginning of 2022, we were looking at low interest rates. That's why they were called a fixed index annuity. All of a sudden, we started seeing the 10-year Treasury in the 4 to 5% range. When you have the 10-year Treasury in a 4 to 5% range, all of a sudden now we're starting to see some of these strategies provide a double-digit return. And so therefore, again, I truly believe we can call them equity index annuities again because of where interest rates are now. Now, if you do have a securities license, we have 2 additional annuities. One's called a hybrid variable annuity, otherwise called a RILA, a registered index linked annuity. The returns are based on those same type of indices within the fixed index annuity, but there is a little bit of downside risk for a greater opportunity for returns. Okay, so again, you do have to have a securities license for the RILA. The last is the variable annuity. That's the one that Susie Orman talks about a lot. Susie Orman talks a lot about the RILAs because of the fact that they have extremely high costs. So when you take a look at the variable annuity, yes, you've got great opportunity for growth because those sub-accounts are just like mutual funds, but the fees are extremely high. So again, when we take a look at the consumer out there right now, most of our consumers are looking for positive returns, higher than normal returns, without any downside risk. And again, that is your fixed index annuity. So again, fixed index annuities, and again, I'll go through this pretty quickly, but safety of principal, no downside risk. Zero's your hero. If the market goes negative, you'll never lose a penny. How do we do that? It's in the investment markets that we use to go ahead and invest to get a return on the positive side. If the markets ever go negative, the contract that we buy never ever is exercised. So therefore, there is no downside risk. It avoids probate. Inside of any annuity, any retirement account, IRA, or life insurance, we have a named designated beneficiary. By having that beneficiary, it avoids probate because it has a direct determination as to who's going to get the money. When you have a will states it, but again, it's not ironclad. A trust is ironclad. A will is not. If you just have your money in your name, it will go through probate, which right now is costing anywhere between 4 to 7% of the asset. So if I have $100,000 and it's probatable, that's $4,000 to $7,000 cost. That's not good. Liquidity. Typically, an annuity has a 10% free withdrawal. Some of the annuities today now are anywhere from 5 to 10% free withdrawal. Why? To get better growth opportunity. Some of our more accumulation products are going to be a 5% free withdrawal. Why? Because it's an accumulation product. Most likely, we're not going to touch it for a 7 to 10 year period of time. So again, when we take a look at it, penalty-free access, usually 10%, but it could be anywhere between 5 and 7. No upfront costs or fees, so 100% of your work goes to work immediately for you. Tax deferred growth, meaning that you're not going to pay taxes on any of the deferred interest that you're accumulating, or on the amount that otherwise might have been paid in taxes if it's a non-qualified account, like a CD that's after-tax money. Payout options on any of your index annuities or any annuities, period, you can annuitize, or the majority of the annuities now have what is called a guaranteed income for life or a guaranteed minimum withdrawal benefit. So again, there's ways in which we can create the ability to get a pension-like income through these payout options. And lastly, again, on the fixed index annuities, we are seeing the returns based on markets like the S&P 500, like the NASDAQ, like the EFA, or one of these volatile control strategies. So again, higher potential returns. Most of our consumers out there that are getting ready to retire, if you ask them, are you prepared for retirement? Do you feel like you have enough money for retirement? 9 times out of 10, the answer is going to be a big no. But can they afford to lose money? No, I can't afford to lose money. So therefore, again, if I can share with you a program where we can reposition some of your retirement assets, and in this asset, if the market goes up, we're going to make money. If the market ever goes negative, we'll never lose a penny. Is that something that might be of interest to you? Keep it simple. So again, annuities are long-term growth vehicles that offer the specific tax-deferred advantages for retirement planning. Now, can they be used as an alternative to like a CD? Absolutely. Can it be used as an alternative to a mutual fund? Absolutely. But annuities were built specifically for retirement alternative strategies. Participants in an annuity are going to be the owner, the annuitant, and the beneficiaries. The owner and beneficiary can be changed, but the annuitant must be a living, breathing human being. The owner could be a trust or a business. Again, the beneficiary could be a trust or a business, but the annuitant must be a live, breathing human being. The role of the owner is to be able to select beneficiaries, and if it's not the same as the owner, select an annuitant. The person whose life the annuity contract and the annuity options are based is the annuitant, who we're going to base an income stream off of. The phases of annuity are the accumulation phase, which is the deferral time frame, deferring that interest to a later date, and then the payout phase, which is going to be our income time frame. Whether we are annuitizing the contract to get the highest income possible with giving up control of the asset, or by turning on a guaranteed income for life, okay? That's all going to be determined based upon the client's situation at retirement, okay? During the accumulation phase, again, the money grows tax deferred during our working years. Payments are made through either a flexible premium or a single premium, and I will tell you on an index annuity, single premium is the best way to do it, but we do have 2 carriers that will go ahead and allow flexible premium, North American and F&G. Again, they're different, so give us a call if you have a flexible premium situation, and we can determine which one's going to be the best. And during the accumulation phases, changes can be made to the contract. During the deferral, or the deferred annuities, you have the single premium deferred annuities, so again, 1 premium payment, flexible premium, multiple premiums to the annuity. Power of tax deferral. Tax deferred accumulation is double tax deferred or triple compounding on the non-qualified accounts. With this, you're going to earn interest on your principal. You're going to earn interest on the earnings, which is the compounding effect. And on non-qualified money, you're going to earn interest on your money that would have otherwise been taxed. So if I've got money in a mutual fund or a CD and it's non-IRA money, or is what I call the tax now bucket, okay, I'm paying taxes on every dividend, every capital gain, or every interest payment that I accrue during that year. In the annuity, if it's non-qualified money, I earn interest on the principal, I earn interest on the interest, and I earn interest on the amount that otherwise would have been taxed if I had been in a mutual fund or a CD. So again, triple compounding, it will grow faster, okay? As I mentioned, liquidity features, the annuities may have a limited free withdrawal that lets you take out one or more withdrawals without any type of surrender charge or a commitment charge. Did you have a question, Lucida? Okay. So again, yeah, the size of the withdrawal, actually, I got to change this because we now have 5% to up to 10% is often the limit set by, to a set percentage of the contract value. Now, we do have a couple of companies that have what we call a daily valuation, the Athene Velocity, and the Nationwide New Heights 9. They have what's called a daily valuation, and so you can take your percentage of free withdrawal at any time, and we will value the contract that day. So if the value is increased from the previous anniversary, we're going to be able to take a withdrawal of the higher amount. That's huge. So again, that's the Athene Velocity and the Nationwide New Heights 9. Now again, some annuity companies will waive surrender charges, okay, such as death, nursing home, terminal illness, things of that nature. Please check your state specific. California does not have nursing home. Massachusetts and Minnesota, I do not believe, have a nursing home waiver. So again, there is some liquidity, but not 100% in all states. Death benefit is usually going to be the remaining value in the contract. Now, 2 companies do have the capability, actually 3 companies have the ability to go ahead and have the guaranteed minimum benefit base paid out over a 5-year period of time. Generally speaking, the income benefit base or guaranteed minimum benefit base is up here, the policy values here. Policy value can be taken lump sum in the first year. The guaranteed minimum benefit base can be a higher value, but has to be taken out over a 5-year period of time. So that's going to be the, are we still good?
Yeah.
Okay. So again, the Agility 7 and 10 from Athene, North American Benefit Solutions, as well as the Allianz, I believe it's the ABC, or excuse me, not the ABC, the 222, have the capability of doing the 5-year payout of the guaranteed minimum withdrawal benefit base. So again, a few unique twists there. Again, index annuities are different from other fixed annuities because of the way we credit interest to the annuity's value. The indexes are crediting interest using formulation based on the index in which we are linking it to. Okay? Fixed annuities and index annuities also promise to pay a minimum interest rate. At a certain point, even if the value of the contract is a 0, meaning we're getting a 0% rate of return, we have a guaranteed minimum interest to the point where that guaranteed minimum interest may exceed the policy value. So we will always have a guaranteed interest rate on our index annuities and our fixed annuities. So real quickly, here's how we go ahead and determine the interest that we're going to credit. So again, we have the S&P 500. Let's say it's a 1-year point to point. Here's the beginning point, and here's the ending point. Okay? So how does the protection work? How do I guarantee a floor of 0? Again, if the S&P 500 starts off at 2,000 and at the end of a year it's worth 1,500, we've got a guaranteed floor of 0. The client will lose nothing. Okay? But if we have a cap strategy, I liken a cap to putting a trampoline in your living room. Imagine that. You put the trampoline in your living room and your kids are up, jumping up and down on the living room, on the trampoline in the living room. What are they doing? They're hitting their head on the ceiling. That's like a cap. Okay? So a cap is a maximum height that we can go to. So again, the S&P 500, 2,000 is the beginning value, 9% cap. We go to 2,300. That's a 15% return. The client will get 9%. Okay? If we got a 5% return, the client would have gotten 5%. Okay? Now, there's what we call a participation rate. Participation rate is how much are we going to participate in the returns of the market. So again, S&P 500, values 200, 85% participation rate. The value goes up to 2,200, which is a 10% return. 85% of 10 would be an 8.5% credit. Again, we're going to get these returns. Why? Why aren't we going to get the full 10% or the 15%? Because we have a guaranteed floor of 0. We'll never ever lose any money. When I was an advisor and I was utilizing the index annuities, this was in my war book. Okay? This was in my war book, and I had this in a clear folder. Okay? I would show this to the client. And ultimately, what I would do is I'd have a couple of pieces of white piece of paper that I would present on, like I showed last week. But what I did was I went ahead and I took that white piece of paper and I covered all of the red. And I said, Mr. and Mrs. Client, if I can cover up all that red, never have any losses, and then I cover up some of the peaks of the green, while giving you some of the upside of the green, would that be of interest to you? Here, if I look at my negative years and my positive years, 55 years of positive, 19 of negative over the last 74 years, 74% of the time I had a positive return, 20%, 6% of the time I had a negative return. The average return when it was positive was 16.39. The average when it was negative was 13.05. If I can eliminate that 13.05 while getting some of that 16, would that be of interest to you? Okay? So again, most of our consumers, as we get older, are at a point where they can't afford the losses. They can't afford a 19.4% loss in 2022. Okay? So again, when we take a look at it, we can't afford the losses, but we're happy with the opportunity for growth that we can get today. Now, this is a little cheesy. This is something that I used to go ahead and show back in my days of working with ING and Voya. So Mr. and Mrs. Client, CDs, money market savings accounts, and fixed annuities, they're great because they're safe. Problem is the returns are low. So what's the alternative? The alternative is mutual fund stocks or variable annuities. The benefit of those is that they've got the potential for upside return. The downside is the risk. So Mr. and Mrs. Client, if I can share with you a program that's got safety and the potential without the low returns and without the risk, would you be interested in that? Absolutely. It's called a fixed index annuity. So again, some of the issues that people are facing today, it's low yielding investments, low yielding income for retirement. The option for higher yields are too risky for most people. And what clients are looking for is safety of opportunity. So they go to the bank because they think the bank is safe. FDIC. FDIC to me stands for funds don't increase correctly. But it's the Federal the Federal Depository Insurance Corporation. Right now, FDIC has a fraction of a dollar in reserves for every $1 in liability. So they have a fraction of a dollar in reserves for every $1 in liability, up to a $250,000 limit. RBC is what protects insurance companies. It's called risk-based capital, and it protects the client. Risk-based capital is how much money do I have in reserve to cover the client's liabilities. So for instance, the best out there is going to be Nationwide. Nationwide has about $6 in reserves for every $1 in liability. Our lowest is going to be about $3.75 in reserve, and that's with F&G. $3.75 in reserves for every $1 in liability. That's significantly better than FDIC all day long. So again, we'll talk about ways in which we can overcome the objections. Again, I'm not going to go into that today. So again, the key things on the fixed index annuities: single premium or flexible premium, tax deferred growth, triple compounding for non-qualified, market participation with no market losses. The income for life is optional, okay? Usually it will come with a fee. And then the remainder benefits will go to the beneficiary. So whatever is left over after income is paid out will go to the beneficiaries, okay? So again, hopefully this was helpful. Actually, we're gonna go ahead and continue on. Sorry about this. Let me go here. Suitability. This is something that has been a major issue in trying to get things done quickly, okay? So suitability takes a look at the liquid net worth of the client, emergency funds, and then the Right Bridge Annuity Analyzer. So what is constituted as a liquid net worth? Cash in the bank. It could be a CD, money market savings, or checking account. Mutual funds. It could be gold and silver. It could be your retirement asset, an IRA, 401k, 403b, 457, or even a pension, as long as you're over the age of 59 and a half. Any of the retirement assets prior to age 59 and a half has a penalty if they needed to access to the funds. And again, that is not considered a liquid asset. A secondary piece of real estate, investment property, not the primary residence. And we will not consider individual cryptocurrencies as a liquid net worth. We now have 2 ETFs that do invest in crypto. If it is in the ETF, we will consider that as liquid net worth. So most of our compliance and suitability issues are around the liquid net worth. If your liquid net worth is under $100,000, we can put no more than 50% of your liquid net worth into an annuity, okay? If you have 100,000 or more, we can go up to 70% of your liquid net worth into an annuity, okay? So please note that you have that capability, up to 70%. Now, if it is 70%, you will get a yellow or a red Right Bridge Annuity Analyzer, and it will have to go to WFGFA review, and I'll share with you how that works in just a second. But the second part of suitability is for pre-retirees. You're gonna need 3 to 6 months of living expenses, whatever their monthly nut is, their living expenses, their essential expenses, whatever their living expenses are, 3 to 6 months in the bank. If they have retirement, or if they're retired, 6 to 12 months of their living expenses in the bank. We must have those emergency funds because, again, pre-retiree is if you lose your job. Post-retirement is if you get sick. We need to make sure that the annuity is the last resource that you go after. Okay? Every case that we do, we must do the Right Bridge Annuity Analyzer. That is your suitability also. If the Right Bridge comes out green, which is a good thing, that Right Bridge or that annuity application will go directly to the carrier. Okay? If it is a yellow or red, it must go to WFGFA review. If it is a replacement of another annuity, not a TSA. TSA is a qualified retirement account, not a traditional annuity. But if we have a traditional annuity and we're replacing it, it has to go to a WFGFA review. Or if it's over $1 million in premium, it has to go to WFGFA review. Now, we've had two cases just recently, a 4.4 and a $2.3 million case that had to go to WFGFA review. Both of them were approved in a day. So we're getting it done. How? How can we get it done that quickly when most of the time within WFGFA review is taking anywhere between 4 and 7 days to get it approved? Well, we have all of the questions that the WFGFA review team is going to ask. So again, red or yellow Right Bridge Annuity Wizard report, the app is a replacement, or the premium's over $1 million. Here are your questions. Please do me a favor. I'm going to go ahead and pause, take a sip of water, take a picture of this, and I will go ahead and send it on over to Ricky. And Ricky, if you could, maybe disperse it on out. All right. So, be proactive. If you have one of those three situations and it is going to go to WFGFA review, be proactive and attach a letter of understanding that answers all of these questions. Okay? So just create a PDF or a Word document, whatever you want. Create it, answer these questions. Okay? Attach it to your Firelight application. They're going to go ahead and review that and get back to you pretty darn quickly. Now this says 10 to 15 business days. They've definitely hired more people. Right now it's 4 to 7 business days. But again, if you do not put the letter of understanding, what's going to happen is WFGFA review will go ahead and email you. And you guys get a lot of emails, right? Sometimes they get lost. You overlook them. And next thing you know, a week's gone by. And then you finally find it, you answer the questions, you send it back into WFGFA review. Guess where it goes? The end of the line. And now you've got to wait until WFGFA review gets through all of the other reviews before yours. Okay? Now, again, that's wasted time. Do the letter of understanding, get that attached to the Firelight application, and it will get approved very, very quickly if it is in good order. If it is not in good order, watch your emails. They'll go ahead and email you and ask for more information or give you a flat out decline. So that brings me to my last point. Do not ever initiate any replacement or rollover until you've received notification that WFGFA review has approved the case. Okay? We have had numerous situations occur where the process has started for replacement or a rollover, okay, or even a trustee to trustee transfer. And so what ended up happening was WFG came back and said, no, this is not a suitable transaction. We just had it happen in a case today. Check is being returned to the client because once we have a check that's cut from the old company, guess what? That account's closed now. So all of a sudden that money's now going to go back to the client. If it's a qualified account, we got time limits. And so again, if that money goes back to the client, we don't ever want a situation where there's a taxable event. So again, be proactive. So with that, I'm going to go ahead and stop. See if you guys have any questions. And again, I hope this was helpful.
Yes, Dave, I'll start the question. Just a clarification for the non-qualified accounts. The client will consume the principal first before they will be taxed, or they'll be taxed right away? And
well, once they start taking out distributions, it's called LIFO. Last in, first out. So LIFO means what is the last monies to go into the contract? It's going to be the interest. So that will be the first to come out. In a non-qualified annuity, if let's say, for instance, I put $100,000 in, 5 years later or 10 years later, whatever, it's worth $150,000, and I start withdrawing, the first $50,000 will come out, and the first $50,000 will be taxable. So you're going to be taxed on the interest first. Once the interest comes out and it's been taxed, and we start now to invade the principal, all that will be tax-free because of the fact that's already been taxed.
Okay. How about for the immediate annuities then?
So now immediate annuities are different. Immediate annuities have what's called an exclusion ratio. Each payment is going to have a portion of principal and a portion of interest. So a portion of the money will be tax-free, the principal portion, and a portion will be taxable. So it's definitely spread out. It's a lot lesser of a burden of taxation if you do an immediate annuity.
How's the computation for that? Do they get an illustration or something?
Yeah, well, we can get the payment sheet. Okay. So they've gotten a lot better. Why? Because interest rates are higher. Remember, the insurance carrier is going to take your money, and we invest it. The higher the interest rate we're earning, the more we're going to pass along to the client. Okay. So yeah, it is competitive. But again, remember, when a client goes ahead and puts money into an immediate annuity, they lose control of the principal. So they lose control of the principal in lieu of monthly payments.
Okay. Because the reason why I ask, most people, maybe some of them don't roll over yet until they retire. So let's say I have a client who's retiring end of the year, then they don't want to touch their 401k at all, because they believe that it's safe in their job, and then they will decide to roll over once after their last day at work. So that ends in December, and they want to get money right away, which is the following year, because they don't have any wages anymore. And I talk about this concept. Why don't you can start your money anytime you want. You can even start next week if you want. That comes immediate annuity.
So again, you can do index annuities, maintaining control, taking income after 30 days. So we have AIG Corebridge, we have Athene, we've got North American, where you can take income after 30 days. Okay, so the one thing, as I had mentioned last week and the week before, we've got a lot of situations where consumers out there who are over the age of 50, they've got money in their 401k. The key question is, Ricky, is that 401k money, is that protected from loss? And the answer is no. Yeah. Whether it's on the roller coaster ride in the market or on the kiddie ride earning a little bit of interest, it's not protected. If you're on the roller coaster ride, you've got loss potentials from the market. If you're on the kiddie ride, you're losing due to inflation. Okay? So Ricky, let me ask you a question. If there was a way in which we could reposition some of your retirement assets today while you're still working, And within this program, it's going to grow tax deferred just like your 401k. Now, within this program, if the markets go higher, we're going to participate in some of the upside of the market. But here's the beautiful thing, Ricky. If the market ever goes negative, you're never going to lose a penny due to market losses. So does it make sense right now to see if we can protect some of your retirement assets from any future losses while still getting potential returns of the market? Does that make sense?
Absolutely.
Great. Let's go ahead and see if we can go ahead and do that. You said you had your retirement plan with Fidelity, right? Please send me a copy of the statement and we'll do a 3-way call. You'll have to identify yourselves as a plan participant, and then you can turn the call over to me and I'll ask the questions. Does that sound good?
Yeah. All right. Cool. Next question. We have 9 minutes for your.
Hey, Angie. Did you have a question? Okay. I thought you were unmuted.
I have a quick question for somebody. She's shy. Is there maintenance fees for FIAs?
Maintenance fees? No. There are fees potentially. So you could have a strategy charge to get higher participation rates. That's completely optional. Or if you're looking for a guaranteed income for life, there could be an income benefit rider fee. Okay? And that is an annual fee based on your income benefit base. So if that income benefit base is growing, the fee is increasing, but so is your potential for retirement income. Now, when I hear maintenance fee, I think of like a variable annuity or a mutual fund. Yeah, but there is no maintenance fee per se in an index annuity. You have a strategy charge or an income benefit rider charge or potentially an enhanced death benefit charge.
How much is the percentage usually for those strategy fee?
It can range anywhere from 0.75 all the way up to 1.25.
Okay.
The income benefit rider charges are usually right around 1% to 1.15%. And the enhanced death benefit charge is usually 0.5%.
Okay. All right. Very minimum. Thank you.
Yeah. A lot lower than most of your variable annuities.
Thank you, Rick.
You're welcome.
So usually, Dave, just a follow-up question on that. How do you handle the objection or the client's response wherein they say, "Oh, you charge more than 1% for that rider lifetime income"?
Mm-hmm.
So what if they said, "Oh, I don't want to pay that 1%. I'll just stay here"? How do you
So we do have other options where there is a no charge at all. So I have a no fee, but there are some parameters that you have to adhere to. But Ricky, let me ask you a question. Have you ever heard of the terminology CFP, College for Financial Planning?
Yeah.
Okay, so the College for Financial Planning has done research on this. And they basically have said that anyone who is 65 years old and older, okay, in order to go ahead, based on back testing, you need to have, if you're husband and wife, 65 years old, you need to have your money invested 50% in the stock market, 50% in the bond market. And in order to guarantee to have $1 left at the end of 20 years, guess what? You have to take out less than 3% per year. So do you have like $2 million in your retirement account? Because that's $60,000 a year. If you have $1 million, it's $30,000 a year. If you've got 500,000, that's $15,000 a year. To have a high probability of having $1 left at the end of 20 years. This program that has a 1% fee will be able to go ahead and determine and guarantee your paycheck. And I can guarantee you that percentage of that paycheck to the principal amount invested is going to be somewhere around 8-9%. So how can we do that? We charge a fee. Are you okay with us charging a fee to get 8-9% income?
Yeah.
Okay. I mean, again, the fee has huge benefits. Now, guess what, Ricky? As I had mentioned before, with the CFP, less than 3% to have $1 left after 20 years. What happens if you live to the 21st year? Well, in that first one, less than 3%, I got nothing left. Within the program I'm suggesting with the 1% fee, if the value goes to zero at the end of 20 years, guess what? You and your spouse are going to continue getting that income for the rest of your lives. So is that worth it?
Yeah.
Yeah, it is. It's totally worth it.
All right. Thank you, Dave. Next question.
Just a follow-up. So the fees are annual, right?
They're annual fees, yes.
All right, thank you.
Hello, anybody? Ask question.
And I gotta get some new lighting. I look like I'm a blue man.
Ask David question now instead of asking bossing or asking me. At least you heard it from him. Sometimes you heard it from somebody, then you believe it more than right? Well, I'm not saying you don't believe us, but it's always good to have a first-hand info. So now is your chance. And rollover is so hot right now.
I have a question.
There you go.
Yes.
Questions.
All right.
So I actually have a coworker, and she had mentioned that she's working with Edward Jones, and because she's retiring next year. How would I approach her about roll over her money into an FIA instead of rolling it over with Edward Jones? What would be the benefit?
Sure. How old is she?
She'll be 62.
Perfect. What's her name?
Debbie.
Debbie. So Debbie, let me ask you this. And she's still working, right?
Yes.
Okay, so Debbie, let me ask you this. At your 401k or at your retirement plan at work,
Mm-hmm.
is it protected? And she's gonna say, what do you mean protected? Well, is it on a roller coaster ride? Meaning, in 2021 it was negative, in 2022 it was positive, 2021 it was positive, then negative, then positive. Who knows what it's gonna do this year? It's up and down.
Mm-hmm.
So when it was negative, how did that make you feel? It was negative 19% in 2022. How did that make you feel? We want the emotions. We want her to get emotional. Okay? She's gonna go, gosh, I hated it. But then the market was up in the following year. Then I was happy. And then I'm happy. Then I'm sad. I'm looking at the market and I'm happy and I'm sad. If there was a way in which we could go ahead and reposition some of those retirement assets today while you're still working, guess what? Unlike Edward Jones, you're going to be on the roller coaster ride. And the maximum you should be taking is 3%. Do you have longevity in your family lineage? If you have longevity, guess what? You'll most likely run out of money. If you run out of money, what's going to happen at that point? Okay. Now, the programs that I'm suggesting to you, Debbie, is one that allows you to reposition your retirement assets, potentially today if you wanted to. And in this program, it's going to grow tax deferred, just like your 401k or an IRA at Edward Jones. Okay. Here's the difference. Okay. If the markets go higher, we're going to make money. But if the markets go negative, you'll never lose a penny. At Edward Jones, if the markets go negative, whether it's the bond market or the stock market, if the market goes negative, you'll lose money. Now, within this program, we can set it up also where we go ahead and set up an income stream that's going to be payable you on a monthly basis when you decide you want to take it. And within this program, that income stream, even if the value goes to zero, it's going to continue to pay. Now they're going to go, oh, how can you do that? That sounds too good to be true. Well, you know, Debbie, this type of program's been around for over 30 years. And being able to provide that income has definitely been around for probably about 25 years. So, no, it's nothing new. I'm surprised you haven't heard. Your Edward Jones guy hasn't talked to you about this? I'm really glad we're talking about it right now because I think this is a better fit. It's going to give you upside return on the market, but if the market ever goes negative, you don't have to ever worry about losing money. You don't have to have that fear that your value's going down. And even if the value goes to zero, which it could because it's a retirement account, if the value goes to zero and you're still living, guess what? It's going to continue paying you an income stream. Whereas if it goes to zero at Edward Jones, you will not receive 1 penny more. So which one makes the most sense to you?
Lifetime income.
Yeah.
Thank you.
You're welcome. My pleasure.
All right. Any other question? Last question. It's past 8 now.
I have one question.
Oh, there you go, Ate Fe.
Awesome.
Okay, my question is, say the client rolled over 300,000 and she wanna grow it on like 5 years. And then on the 6th year, she started to do the lifetime income. On the 7th year, something happened to her. She passed away.
Mm-hmm.
And approximately, probably she just used, let's say 20,000 from the 300,000. What happens to the remaining?
Goes to the beneficiaries.
So the full amount remaining that she did not use will be given to the beneficiary?
Sure. And over the 5 years, you're going to have some growth. So let's say the 300,000 grew to 400,000.
Mm-hmm.
Okay. Starts lifetime income. She takes out $20,000 a year in that year. She passes away. $380,000 will go to the beneficiaries.
Okay. Does she have to get an extra rider to have a benefit?
Nope.
All right. Thank you so much.
The only way that would not go to her beneficiaries if she does an annuitization with life-only payment option. But in the income benefit riders that we have, those are not annuitizations.
All right. Anyway, thank you, Dave. To summarize our discussion for tonight, for me, you know what? You ask the client, what percent of your money do you want to protect? So that means safety. So second one, you're growing your money. Same thing as you're in your job right now, you're growing it tax deferred. Because mostly they're afraid of moving their money, even though they're still employed, of the tax complication or implication, I mean.
Yep.
And lastly, how would you like to have an income for life? So, and then I will relate that question to that. Did you know that did you work in an employer wherein you contribute to Social Security? Then you get your Social Security. Is your company providing pension? Then you get that second source of income. How do you like to have your third source of income for life? So that money you're not gonna outlive with. So, and then you close the deal by, okay, let's set up an appointment. When are you free along with your husband? And close the deal, right?
Mm-hmm.
So that's it for tonight. Thank you, Dave. We'll see you next week for our last session.
Yeah, and I'm gonna check with you, Ricky. I am gonna be traveling next week, but let me see if I can go ahead and do it at 7:00 Pacific Standard Time.
Sure.
Awesome. Thanks so much.
Thank you, Dave.
Bye bye.
Okay. Good night, everyone.
Thank you. Thank you.